6. Smart financial truths every UK adult should know in 2026. Have you ever looked at your bank account, looked at people online, and thought, how is everyone else suddenly buying houses, driving nicer cars, and acting like they've got money completely sorted? Because the truth is, most people in the UK aren't bad with money. They're just missing a few key habits that quietly make all the difference. And a simple plan that actually fits real life in the UK. And that matters in 2026. Because life is expensive, tax is still taking a huge bite, and if you keep drifting, you can lose years without even noticing. It's about what you keep, how you use it, and the small decisions you repeat over time. And the reality is, you can feel like you're doing everything right, and still not make the progress you expected. So, in this video, I'm going to walk you through 6 smart financial truths you need to understand in the UK right now. First, how to figure out where you really stand financially. Second, why earning more doesn't always improve your finances. Third, the correct order to build wealth. Fourth, the tax basics that help you avoid overpaying. Fifth, how to make better use of your pension. And sixth, what wealth really looks like at each stage of life. If you understand these, you're already ahead of where most people start. First thing we're going to talk about is knowing your real financial position, not your guess. The first habit is simple, but often overlooked. Actually knowing your numbers, not roughly, not I think I'm doing okay, but clearly and honestly. You need 3 key figures: your yearly income after tax, your yearly spending, and the gap between them. That gap shows whether you're moving forward or standing still. For example, someone earning £42,000 after tax, but spending £40,500 a year, may feel comfortable month to month, but they're only building £1,500 across the entire year. That's a very different picture when you zoom out, and that's why looking at your finances yearly is so important. Because real life includes utilities, renewals, travel, unexpected repairs and expenses, and seasonal spending. Monthly snapshots don't always capture that. Then look at your net worth, what you own, minus what you owe. Savings, investments, pensions, property, minus loans, credit cards, and fixed expenses. Because income supports your lifestyle, but net worth supports your future. And one important reminder, it's easy to compare yourself to what you see online. But in reality, many households build wealth gradually over time, and much of it sits in pensions or property, rather than accessible cash. So step 1 is about clarity. Because once you understand where you are, you can make better decisions about where to go next. Second topic. Stop lifestyle creep before it slows you down. The second habit is recognizing something that can quietly hold people back. Lifestyle creep, this is when your income increases, but your spending rises alongside it, so your financial position doesn't improve as much as it could. For example, a pay rise might lead to higher car costs, more frequent spending on eating out, additional subscriptions, general upgrades in day-to-day spending. None of these are necessarily wrong, but without awareness they can absorb progress. This tends to become more noticeable in your 30s and 40s, when both income and responsibilities increase. So instead of asking, can I afford this? A more helpful question is, does this support the life I want to build? There's a difference between spending that adds real value and spending that simply keeps up with expectations. A practical approach is to focus on improving your overall structure first, building savings, increasing investments, strengthening your financial position, then making conscious decisions about spending. It's not about cutting everything, it's about being intentional. And this is especially relevant right now in 2026, because while wages have increased for some people, so have everyday costs, energy bills, rent, food, they've all remained relatively high compared to just a few years ago. So what often happens is this. Someone gets a £3,000 pay rise, but their rent goes up by £150 a month. Their food shop increases by £50 a month, and their car insurance renews higher than expected. That's over £2,400 of extra cost across the year before they've even made a single lifestyle upgrade. Then on top of that, they treat themselves a bit more because they feel better off. And suddenly, the pay rise is gone. Not because they made bad decisions, but because they didn't adjust intentionally. So a smarter habit in 2026 is this. Every time your income increases, decide in advance where that extra money goes. For example, 50% towards improving your future, such as savings, investing, and pension, and 50% towards improving your lifestyle. That way you still enjoy your money, but you also move forward, because the goal isn't to restrict your life, it's to make sure your money is actually improving it, not just disappearing. Third topic. Build wealth in the right order. The third habit is understanding the order that tends to work best. Because many people are doing the right things, just not in the most effective sequence. A simple structure is, step 1, build a financial buffer. Even a modest emergency fund can reduce reliance on credit when unexpected costs arise. Step 2, address high-interest debt. Where possible, reducing expensive debt can improve your financial position more quickly. Step 3. Start building longer-term wealth. This often includes saving for short-term needs and investing for longer-term goals. You don't need to wait until everything is perfect. Even small, consistent steps can build momentum over time. For example, if someone has £300 spare each month, they might allocate part towards savings and part toward long-term investing. In the UK, there are also tax-efficient options, such as ISAs with an annual allowance of £20,000, and pensions which may benefit from tax relief. The key idea is match your money to your timeline. Short-term money stays accessible. Long-term money can be invested with a longer view. Fourth topic is to understand the tax basics to avoid unnecessary mistakes. You don't need to be a tax expert, but having a basic understanding can help you avoid common issues. For the 2026 to 27 tax year in the UK, personal allowance, £12,570. Basic rate is 20% for income up to £50,270. Higher rate is 40% for income of £50,271 to £125,140. Additional rate is 45% for income over £125,140. Once your income goes over £100,000, your personal allowance starts to reduce. For every £2 you earn above £100,000, you lose £1 of your tax-free allowance. That means by the time your income reaches £125,140, your personal allowance is completely gone. And this creates an effective tax rate of around 60% on that slice of income between £100,000 and £125,140. So even though the headline rate says 40%, in reality, that band can be significantly higher. This is why planning becomes more important as income increases. For example, some people use pension contributions or charitable donations to reduce their taxable income back below £100,000, which can help preserve their personal allowance. The key takeaway is simple. As your income grows, understanding how the tax system works becomes more valuable, because small adjustments can make a noticeable difference over time. Some simple but important checks include: Number 1. Reviewing your tax code. Your tax code tells your employer how much tax to take from your salary. If it's wrong, your tax is wrong, and this happens more often than people realize. For example, if you've changed jobs, have multiple sources of income, or had benefits like a company car, HMRC might adjust your code. You might see something unusual like a K code, which can mean HMRC is collecting tax you owe from a previous year. Or your personal allowance might be reduced without you fully noticing. Now here's the key point. If too much tax is being taken, you're effectively giving HMRC an interest-free loan. If too little is being taken, you could face a bill later. So a quick check on your payslip or HMRC website can make a real difference. Number 2. Being aware of deadlines. If you need to complete a self-assessment, timing matters. The deadline is the 31st of January following the end of the tax year. Miss that, and there's an automatic £100 penalty. And it doesn't stop there. The longer it's late, the more penalties and interest can build. A common situation is someone who starts freelance work, earns some side income or has rental income, but doesn't realize they need to register and file. Then January comes around, and it becomes stressful very quickly. A simple habit is this: if your situation changes, check early, because leaving it until the deadline turns a simple task into pressure. And number 3. Understanding pension tax relief. This is one of the most overlooked areas, because not all pension contributions are treated the same. In many workplace pensions, tax relief is added automatically at basic rate. But if you're a higher rate or additional rate taxpayer, you may be entitled to more relief that isn't applied automatically. For example, if you contribute £1,000 into a pension, your provider may top it up to £1,250 with basic rate relief. But if you're a higher rate taxpayer, you could potentially claim back an additional £250 through HMRC. And many people simply don't claim it. Over time, that adds up to thousands. Especially now, as more people are being pulled into higher tax bands without necessarily feeling wealthier. Taking a little time to understand these areas can help reduce the chance of overpaying or missing something important, because with tax, small details can make a big difference over time. Now, let's go to the 5th topic. Treat your pension as future income. The 5th habit is paying attention to your pension. It can feel distant, but it plays a significant role in long-term financial planning. There are 3 useful things to check. Number 1. What your pension is invested in. Default funds are designed for broad groups, so it can be helpful to understand how your money is allocated. Number 2. Whether you're receiving employer contributions. If your employer offers matching contributions, contributing enough to receive the full match can be beneficial where affordable. Number 3. How tax relief is applied. For the 2026 to 27 tax year, the standard annual allowance is £60,000, and is subject to tapering for higher earners. Contributions may benefit from tax relief, depending on your circumstances. A useful way to think about your pension is, it represents part of your future income, and reviewing it occasionally can help ensure it aligns with your long-term plans. And the sixth and final topic, understanding wealth by life stage. The final habit is about perspective, because it's very easy to feel behind, even when you're progressing normally. Financial priorities often change over time. In your 20s, building habits and starting early. In your 30s, balancing income, costs, and direction. In your 40s, managing commitments and maintaining progress. In your 50s and beyond, focusing on consolidation and planning. One key point is that a lot of wealth in the UK is not held as cash. It is often tied up in property and pensions, which means people can appear financially secure, but still feel restricted in day-to-day cash flow. So instead of comparing yourself to others, a more useful question is, am I making better financial decisions than I was before? Let's make that practical. Imagine two people both earning £50,000. One of them increases their pension contribution slightly each year, builds a small investment habit, and keeps their lifestyle relatively stable as income grows. The other upgrades their lifestyle each time they earn more, spends a bit more each year, and delays investing because they'll start later. Fast forward 10 to 15 years, on the surface their incomes may not look that different, but their financial positions can be completely different. One has built assets, flexibility, and options. The other may still feel like they're starting over. That's the difference life stage decisions make. Not overnight, but gradually, and then all at once. So instead of focusing on where you should be, focus on making the next decision slightly better than the last, because that's what compounds. So to bring this all together, know your numbers, because clarity drives better decisions. Control lifestyle creep, so your income actually works for you. Follow the right order, so your money builds momentum over time. Understand the basics of tax to avoid unnecessary losses. Use your pension properly, because it shapes your future income. And keep everything in perspective, because progress looks different at every stage. Get these 6 things right, and you're building a strong financial foundation that actually lasts. This content is for general educational purposes only and does not constitute financial advice. Everyone's financial situation is different, so you should consider seeking guidance from an accounting professional or financial advisor before making financial or investment decisions. If you found this helpful, subscribe for more clear, practical UK tax and money guidance.